Hey everybody, it's Brent here from SpotGamma, and I have my good friend Imran from Options Insight. How are you doing today, Imran?
Hey man, how are you?
I'm doing great. The wonderful thing about today's discussion is that the market is having a tough day today, which kind of leads into a bunch of what we wanted to talk about, specifically tail risk and VIX expiration tomorrow, and kind of the way that vol might respond and volatility might respond and behave over the next really 2 months, right? With the Fed, Jackson Hole, and then into the FOMC meeting at the end of the quarter. So the first thing I wanted to talk to you about was today's action. I thought our models looked for a really tight trading range today of about 50 basis points. Now that's the open to close figure, right? So I still could be right. But this is more weakness, as you can see on your screen here, than I was expecting to see. And there's a big VIX expiration tomorrow, and someone that's a little bit smarter than me mentioned that there's a lot of VIX puts expiring. And so I wanted to see, do you think the VIX could be, in the VIX expiration that's tomorrow morning, be kind of shaking things up a little?
Yeah, I mean, potentially that. I think, the last 2 weeks we've pretty much seen unprecedented level of low realized vol, right? So levels like we haven't seen in, say, 2017 even, right? So 5-day realized. I think I saw something out from Charlie McGallagher of Nomura, right? And he was saying 5-day realized was like 1, which is insane.
Yeah.
So, I definitely, you can clearly explain some of that because of this large gamma concentration that we rallied into. And, you've had different sectors passing the baton on the S&P, right? First it was the techs rallying, then it's moved over to the more defensive sectors like utils and staples and things like that. And the S&P just finding an excuse to kind of grind higher in the face of what looks to be deteriorating backdrop, right? The global growth seems to be rolling over. If we look at what's happening in China and some of the data there, and now all of a sudden we got this geopolitical risks come out of nowhere over the weekend, right, with the Taliban taking back control of Afghanistan. And clearly there was some nervousness there on Monday morning where we had our little dip down to your 44.40 range. And then we ripped hard off that, which I think left a lot of people a little bit confused. Now, I wouldn't have been surprised to see us gravitate back to the 44.50 area, but the fact that we got all the way up to 44.80 surprised me. And that just sort of signaled to me that the kind of strength of this pin is kind of going away a little bit, basically. Whereas, we really were struggling and we were in a 1% range at most intraday for the last 2 weeks. And all of a sudden in 24 hours, we've had pretty wild gyrations, even though the street is very long gamma. Yeah. And that was starting to signify to me, maybe I'm not as convinced that this pin's going to hold till Friday, basically, right? So now we've had another sell-off. We've kind of broken a bit away from that. But we're mean reverting, right? You had a 44.20 level today. We're holding off that level. If we can get back up to 50s, it'd be pretty amazing, but it will signify the power of this kind of pin. But it's probably a good shorting opportunity, gun to my head, because I don't see a good reason why this market's rallying other than the fact that there's a load of gamma up there, basically.
Yeah, powerful mean reversion. So a couple of interesting things. We calculated a lot of spider gamma rolled off yesterday at the 445 strike, but the SPX gamma is still quite high. And obviously, as we break below 44.50, we start to lose some of that. And then this 44.20 line that you see on the screen there is kind of like that's our zero gamma kind of line in the sand, right? Like if this thing breaks, then the market could have some trouble. But I think it was kind of the interesting concept is shorting vol, right? Short vol is the easy trade for quite some time, right? Really into tomorrow, arguably, right? So you can keep short and vol, and then all of a sudden we got Fed. Is he going to taper? Or are we not? Taliban, all this other kind of stuff, and kind of maybe you could say that tomorrow signifies, or even I guess it would be today, right? Because everything kind of you got to stop trading today in terms of shorting vol. That now there just could be this sort of everyone who's been short vol is going to start covering now, and that supply of short volatility maybe is exhausted a little bit, right? I mean, every time that there's a little sell off, traders have come out and shorted, volatility in spades, right? So maybe, and to your earlier point, maybe there's a little change here. Maybe there's a little inflection point in the way that people are behaving.
Yeah, I mean, if you look at kind of how VIX futures have traded over the last month, so the main event that the market was kind of pricing was Jackson Hole as kind of a market volatility inducing event. And that was holding up the August futures. And the August futures were kind of acting quite firm. They were holding up. They were struggling to go below 19. And then there was like a period about a week or two ago where people just said, okay, Jackson Hole's not an event anymore, and actually set FOMC meetings more important. That's when we're going to find out more.
Right.
And then August just got crushed. So August VIX got crushed, but you can see the September contract was holding much, much better. And this morning, the spread between those two contracts has got as wide as about 3 vol points, which is kind of as wide as that spread goes, right, in recent memory, right? So clearly the contract now that the market thinks is worth owning is probably September. I think you're right. I think there may have been a load of puts on August that people owned, and that would have made dealers in the VIX space would have made them short vol of vol or short vol gamma, basically, right? And so this kind of spike in August is probably a bit of an unwind of some VIX future shorts that VIX option dealers have been running short against those VIX puts that clients might be long. And that could have well exacerbated some of that pop, because VVIX was holding up pretty well relative to VIX. And that kind of signifies that maybe the street, and when I say the street, I mean the dealer community in VIX, the VIX market makers, they're potentially short VIX optionality. And that would make sense, right? Because those options are pretty cheap. They're quite attractive for buy-side funds to own those, to play that roll down and to play that VIX collapse. And I even had some of those on myself. I had some 16 puts, which I paid 10 cents for, and the 17 puts were quite attractively priced as well. So I can definitely see clients having bought those and dealers having been short those. Yeah.
Yeah. I'll admit that I don't make a habit of looking at the open interest in the VIX levels, but there was a couple 100,000, maybe 150,000 contracts at the 16, and I believe 120 at the 20, 120,000 put contracts expire in the VIX tomorrow at 20 strikes. So, there's definitely some large put positions there that could be, as you said, shifting the way that dealers are position vol and how they're going to have to reposition, I guess, kind of into the close here, right, because of the expiration tomorrow.
Yeah.
Yeah, and you can see that, the VVIX here really did pop around 1230. This is the vol of vol, right? So if this is essentially the VIX on VIX options is really did break out here and move higher. The term structure, as mentioned before, is still the longer dated contracts, VIX futures contracts are still pinned much higher because of this because of the Fed, really, and will he, won't he taper, et cetera. The other interesting thing about the September contract here, in terms of, we're talking about VIX and the Fed, is that it's obviously a quarterly expiration, which is a big one always in the options complex, in the stock options complex. So let's shift, sort of slightly. This is a market that's had an unbelievable run, right? And 4,500 is this massive level in terms of the options gamma. It's kind of it's the top here, really, that we've seen. The market has had an incredible run of tops, and 4,500 has this big contract position. We're now entering this window of uncertainty around the Fed, and will he or won't he adjust? And volatility may be at an inflection point here. So, what are some of the tail risks that you see going into the final quarter here? What are some of the things you're watching? And then 2, how might you want to try to hedge those things?
Sure. I mean, so, I think, there's not that many. We've been kind of tapering's the big one that everyone's wondering about timing, right? So that's becoming less of a tail risk because everyone knows about it, and the market's pricing in some amount of tapering, right? So there was a survey from Bank of America, fund manager survey, 84% of people were saying they expect to taper by year end, and announcement either on Jackson Hole or SEP FOMC or sometime in Q4, and the probability distribution is split across those 3 things. But I think the thing that I found interesting was some of the other tail risks out there, such as, and the Taliban one wasn't really on my radar that much, and I don't think it's necessarily that market moving, but it's not great for sentiment. It's not great for sentiment around Biden, and because there was already quite a lot of political issues going on in the US, right? I thought after the election, I thought Trump had conceded, and the more I'm looking into it, there's still a lot of investigation going on in terms of voter fraud, and he's not letting it go, right? And and there's a large amount of people thinking that Trump's coming back all of a sudden, which I think sounds pretty far fetched. But the market's certainly not looking at that as even a potential outcome, right? So imagine a terrorist that all of a sudden, there's a threat that the election gets unwound and US democracy is put into question. I mean, that's a major terrorist. I'm not saying it's going to happen, but it's a terrorist, right? I mean, the type of moves we would see in markets on the back of something like that are insane. I'm thinking like dollar collapses, Bitcoin up 50% in a day, and I have no idea what equity markets would do, but I'm sure we'd see some volatility, right? So that's something that is kind of lurking there in the background. Obviously, China's the other major one. We all know that China's growth's been slowing down. How's that feeding through to the rest of the market? You look at some of their major ports have been closed. They're disappointing on economic data, but now all of a sudden, with what's going on in Afghanistan, there's people talking about, are they going to make a move for Taiwan, given that the US has put up zero resistance against the Taliban? Is that something that they might try? And then that could cause all kinds of geopolitical tensions, right? So I think on the geopolitics side, definitely risks are rising, and Biden's showing himself not in an amazing light, basically. It seems from what we're hearing.
Yeah, I find because you're in London, your view of sort of the may Trump come back is kind of an interesting view, because we don't hear too much about that here, in kind of the mainstream media, I guess I would say. And we were talking about this idea of, what would you consider, is that a big risk? And Matt, who's our SpotGamma co-founder, he and I don't feel like that's much of a risk or pricing issue. But, one of the things obviously that we brought and talked about is Biden, and, his health is something that I think the market kind of like obviously just ignores. And who knows, the guy could live for another 20 years. When he walks around, he doesn't look like he's that, vibrant. But there is an interesting kind of a shift in confidence, I think, around, the Afghanistan situation. But I think there's also some issues, some tax issues, right? What's going to happen with tax policy, the infrastructure plan? Is there inflation? Is there not inflation? And, into year end, if you feel like there is going to be some shifts in tax policy, and if he's sort of, adjusting the way that, he's looking to move forward, you could have some, kind of tax selling. I mean, this was sort of a theme that came up in 2018 with that big sort of sell-off into Christmas and the Powell pivot and all that. That there's some uncertainty. Like, we've had a great run. We may taper, we may not. What are Biden's policies? Right? Are they pro capitalism, or are they more sort of socialistic kind of policies? That is all uncertainty, right? And I think it's a little less Goldilocks than it's been.
And also the confidence factor on Biden, right? Does that undermine his ability to get through stimulus measures, right? Because I don't think anyone thinks that they're not going to need to do more stimulus in the US at some point, right? And, with some of his people in his own party, Democrats now criticizing him on this foreign policy move. Does that undermine his ability to get through what he needs to get through in the size that the market maybe wants or expects, right? So that's another potential risk out there,
right?
I'd say.
So let's talk, about how you would hedge some of these sort of tail events, right? Let's say particularly in sort of year end, how do you usually structure, hedging your portfolio? Let's say that you have a typical portfolio that's just, long a bunch of equities, right? And you kind of just go along with the market. What do you usually look for in a tail hedge? Like, when do you what's your signal that you may want to put some hedges on? How do you generally like to structure those hedges?
Yeah, sure. So I think this is kind of dependent on what type of investor you are. If you're a fairly active trader who likes to trade the swings and monetize your hedges, or if your hedges are just there, they're expected to lose money, they're expected to bleed, and they just allow you to sleep better at night, that if something crazy happens, you're protected, right? So I'd say on that kind of more passive, I just need some protection for a drawdown in the market, where I don't need to worry too much about monetizing it and taking profit on it quickly if I get a sudden flash crash or something. Then the obvious play is something like a put spread, right? Because we've got relatively low levels of at the money, local volatility, and you've got relatively elevated levels of skew. And so that sets up really well for put spread structures, which buy vol and sell skew.
Right.
And you get pretty decent risk rewards where you buy a put spread that covers you down 10%, let's say, but it'll only cost you a couple of percent or something like that. So I think something like that would make sense for maybe even a year-end protection type trade for a passive type investor who's long.
And then how far out of the money are you typically looking for something like that then?
Like I say, it depends on what the pricing looks like, but where are we? We're at 44. So maybe you want your protection to kick in sort of 2 to 3% out of the money.
Yep.
So maybe kicking in at 43 and kind of ending at around 4,000 or something. So like a 300 point wide put spread that covers you for a drawdown. And you look at that chart, likelihood is if we're going to get a correction, it's probably going to run out of steam somewhere near that 4,000 area. Basically, it'll probably find quite a decent level of support in that 4,000 area.
Yeah.
So that type of put spread structure, I think, could be quite effective for a year-end hedge. Yeah.
Yeah, and I would sort of echo that the 4,000 level. We've talked about this before. There's a ton of open interest at that 4,000 level. That's now 10% drawdown, which is a big drawdown, but as we saw last year, again, last summer, August to September, we drew down 10% in a heartbeat. And the vol of vol, I think, is still, the system's so leveraged, and there's still that reflexive feedback loop of shorting vol that we're going to get sort of the point where maybe it's the credit market tips a little bit, or there's some real sellers that come out there that, you can make that 10% move happen really quite quickly. And I like the idea that that put spread that ends around that case, because odds are again that not much is going to happen, right, as we've seen, but if it does, I think it'll be a really violent quick move that you also need to monetize, right? Because I think the mean reversion is so fast that you don't want to hold that to expiration, right? You want to kind of capitalize on those gains when you have them, when your hedges provide some gains.
Yeah, I mean, if you want something you can monetize, like I said, the put spread's probably more suitable for the more passive person. But if you want something more monetizable, then I'd usually go towards some sort of front month VIX futures if I thought the roll down wasn't too steep. Now the roll down does optically look pretty steep right now.
And that's going this here 20, on the screen, right?
20, if you own September VIX at 20.5 and VIX spot was 17 yesterday,
right?
Arguably that's a 3.5 volt roll down, which doesn't sound too cheap, right?
Right.
Now the reality is that roll down's not linear. It's probably a bit of a step function where it goes from 20.5 to maybe 19 maximum for the first couple of weeks, maybe even 3 weeks, as the market thinks that FOMC is an event worth owning. And then once we get past that, then that September contract can get crushed, basically, right? So I think there's like a sweet spot window of opportunity to own that future, and it will give you quite a lot of reactivity to moves down in spot, but you need to be careful that when it starts to break down, you don't just sit holding it, because you could lose quite a lot of money quite quickly, right?
What about something like a calendar spread in here where you're essentially short, puts or short vol, pre FOMC, pre September OPEX, right? And then long, something in October or November.
Yeah, that could work. I mean, my inkling is that we may sell off into that September meeting as opposed to wait for that meeting and then react to it. I kind of feel like we might sort of price it. If we're going to get bearish about that idea of tapering actually happening, I think post-Jackson Hole, we may start to price that in and actually already trade down early. So I'd be a bit wary about doing the calendar where I sold the front contract and bought the back one, because I actually might want to unwind my hedge before the meeting because we already sold off a bit, basically, right?
Right. Sorry, go ahead. I was gonna say historically, those there's that event vol premium that proves to selling that event vol premium has historically been a good thing to do, right? Because nothing.
Yeah, that's the thing. It's good to own the event as long as you don't hold the option over the event, basically. Right. Own the event, let the event get more and more priced, and more and more people fear the event, but don't hold your option over the event because it usually just evaporates to zero, basically.
Yeah.
Right? So.
Right. And so, that's kind of an interesting idea because I have the current gamma levels on screen here. Now, most of the SPX gamma, the bulk of that expires in the September contract. So these positions here, right, should be pretty stable. And you notice there's a bunch at 4,400, and then there's a whole bunch down at 4,000, which is way off the screen. But I think this position in here is relatively sticky, probably for the next few weeks. Now, if we break below 4,400, I think that's where vol can really pick up, and you get kind of the negative gamma sell-off that we've been talking about. But what's kind of interesting about that ties back into the realized vol has been something like a 4 or 5, depending on how you measure it. And I think we've had a lot of volatility selling into the VIX that expires tomorrow. And then, again, we have some of these unknown events, right? So are you right that there's going to be a bid now in vol in general, particularly into these unknown events? And that could really lead to not so much people wanting to sell, but just the lack of buy, right? The lack of vol supply, of selling supply that we've seen. I think that's kind of what you're getting at into September.
Yeah, I mean, usually we do get this systematic selling into that expiry week, which the market gets supplied with the vol, and then you get this couple of week period where the selling's done, market makers have priced that vol down so they could buy it cheaply. And now the market's freer to move naturally and vol to find its kind of fair value, basically, right? And that's kind of maybe what we're going to go towards. I mean, Charlie McGilligan again mentioned vol control strategies, right? And these are systematic, unemotional, algorithmic strategies that basically measure realized volatility and then scale their positioning to the market based on that realized volatility, right? So he's blaming some of the rally yesterday for vol control, looking at realized vol of 5 or less and being forced to buy billions of dollars of notional into the close.
Right.
Yeah. And if realized vol picks up again, those same guys are going to have to puke their delta back out again, basically, right?
Yeah.
So that might be what triggers the kind of move lower, in that the guys who've just bought a load of delta because vol's signaling so low. We know that realized vol doesn't stay in low single digits for ages generally, right? It's usually an anomaly. The market's just got stuck in this range, and then when it's already starting to show us more intraday realized vol over the last 24 hours. So I would argue if we get that into next week and realized vol has an uptick, all the guys who were having to buy delta yesterday may well need to sell it back 100, 200 points lower next week.
Yeah,
it's very possible.
Yeah, in my view, yesterday, we had a ton of calls expiring at 4:45 in spiders yesterday, and I think those, this was such an algorithmic style of ramp yesterday. I mean, whatever algo got flipped on, right? I mean, this just marched straight higher, unabated, right? And this mean reversion made sense to me because this felt artificial to me, this bid here, right? And I think it might have been tied to all that gamma expiring in spiders. And so, this just reset to fair value, the 44.50. And that's, it is such a good point, right? That you hit a lower bound basically in realized vol, where eventually you keep selling that a 5 realized vol, and it doesn't take much to sting you and make that unwind. And I think that's, kind of what you're more or less getting at here. One of the things that I've seen that's kind of interesting about that is, we have this model that we call the Vanna model, and all this does is it adjusts like what our delta expectation is. That is how much dealers have to buy or sell for their deltas, and then we adjust implied volatility and we create this model. So this sort of showed us that this morning pre-open with the market near 44.50 that dealers had a lot to sell into, right? If the market rallied, and they had a little bit less, but they had some to buy on a drop. And what I wanted to sort of show you was so interesting is that the Qs, which is how I view the NASDAQ, right, has a much different shape to it, right? This is a more volatile sort of neutral stance. And, we talked about the FANGs, right? Apple, Amazon, all these tech stocks. They've been really quite weak over the last several days, even though the S&P is held up. Now the S&P is, I forget what percent of the S&P is just the FANG stocks, but it's a large, meaningful percent, right? So the position in the Qs, from my view, is much more apt to sort of pop and get volatile than the S&P, and you can tell that by this sort of what I would call a neutral stance, right, to this shape versus this stance, which is a lower volatility predicted position.
Mm-hmm. Yeah. I mean, I just generally think the flows as well in options, certainly the selling flows, tend to be bigger on S&P anyway, just because people just feel safer selling S&P vol. And I think the larger systematic vol sellers concentrate more on that stuff.
Yeah.
Basically.
I mean, the stocks that were really leading before for one reason or another, here's Amazon, for example, they're not really leading there. So if your top stocks lose leadership, right, that's sort of a historic axiom there, that when your leaders fail, that's not always a great sign for the market in general.
Yeah, and we've been talking about the breadth of the market being deteriorating, right? As S&P's made new highs and the percentage of stocks above their 50-day moving average is dropping like a stone in the face of a rallying broader market. I mean, that's usually not a healthy sign for the market. I mean, it's managed to keep going for quite a long time, longer than it probably normally would, but lots of things under the hood that make you nervous. And yeah, just because we've had a super low realized vol month, in summer when people are on holiday and things like that, I'm not sure it's going to persist for that much longer, especially with all the stuff on the horizon, basically.
Right. So we're, from our position basically, and we put this in our note this morning, is that it's benefit of the doubt goes to bulls until we break this line here, which is the 4420 kind of gamma flip number, and because outside of the September OPEX, there's really there's not a lot of positions, right? So it's likely that there's bigger funds that are positioned for September. So if we do get some weakness here, there may not be that same response, right? As you mentioned too, from the volatility perspective, to sort of snap things back before the FOMC really in the third week of September. So this next sort of month could be a lot interesting. I mean, it couldn't be a lot more dull than it was over the last couple of weeks.
No, it's going to struggle to be that.
Of 5. So yeah.
But I like your approach where you basically just say, if it breaks the vol trigger, that's when I'll get bearish. I won't try and be cute and clever and preempt that because I just think the market's too high. I won't get emotional about it. I'll use that vol trigger, I'll monitor it, and if we break it, then I've got much more confidence that this could get a lot worse. And basically all you're doing there is say, I don't care about missing the first 50-point sell-off because the next 200 points is where I'm going to make my money, basically, right?
Yeah, that's exactly right. And I think too, sometimes, buying a few puts that are longer dated, I personally took advantage of the counter spread, selling August vol and buying September vol. Which the last couple of days started to hurt. But what's so interesting is we get these little drawdowns that snaps back so fast again, because I think the vol of vol is so sensitive, and the value of options spikes, so quickly here on any kind of a sell-off. But I think in general, like I had so many people commenting on retail sales this morning. They said it's going to be a bad number, which is going to send the market down. And then other people say, well, it's going to be a bad number, which means the Fed's going to stimulate for longer. So that's actually good. Yeah. It's like you don't know which end is up, and you don't really know how the market is going to react to any of this stuff. And so it makes sense to use a metric like that. Or look, when vol is really cheap, you buy it, and when it's really expensive, you sell it. And if we're realizing 5 and the supply of vol should change, then maybe that makes sense to look at getting long game as opposed to short. I mean, I typically look at the S&P in very short dated, in short time frames, and I know that the September at the money straddle just before the open today was $35. That was the one that expired on Friday. So that was pricing in less than a 1% move by Friday. And what's so interesting about that is that most of the gamma is really positioned higher in the market, right? So if vol does come off, if the VIX did come off, that should ratchet up to the 4,500 area. So I think even in the Goldilocks scenario, that $35 is really just the lower bound of how things are priced, if that makes sense.
I agree. I think those really super short dated options do generally get underpriced because the street's just choking on gamma. Yeah. So they often sell that stuff to lighten their theta bill, even though that stuff is too cheap, basically, right? Yeah. So there's a bit of a supply-demand imbalance. They get hit in the 1 month stuff or the 2 to 4 week stuff, and then they use the 1 week and shorter to kind of fund it, and you get this crazy kind of overselling in that. So if you've got a view, often that's a great way to get leverage to that view.
Yeah. So Josh here's asking a question: when's the right time to buy the post OPEX vol spike? Is it OPEX day or after? Well, I think you got to kind of buy it before, right? You don't. That's kind of the issue I think with like shorting today. I know this is a slight tangent, but yes, this is weak, right? So this is the kind of catch-22. And if you're going to buy options, this is kind of buying them in the hole here, right? And so you don't necessarily want to purchase the options here because you could be just paying too much vol and the market should bounce. But this, as Imran, you kind of hinted at this earlier, you want to short this pop, right? Because vol just got cheaper. The market kind of digested some of that sell-off, and that's a much better sort of entry point. But you don't necessarily want to wait for the Monday OPEX if you think that, if you think that volatility spikes after OPEX. I think generally getting in the position before these things move is what can be helpful there, right?
Yeah, I would echo that, and I would also say this stuff is looked at by a lot of people, right? So the conversation we're having is a conversation that's being had by a lot of vol market professionals. So a lot of them are already trying to get into the long vol position post expiry, anticipating that move. So often it all happens early, basically, because everyone's trying to front run it, basically. So I would argue that usually it's too late. If you even wait until Friday, it's probably too late. I generally tend to start accumulating the Friday before, so last Friday, and I've noticed just anecdotally that is often the low tick in vol is that Friday. Then you get the VIX expiry on the Wednesday, which may or may not be a down print. And by the time we get to that Friday where they're actually third Friday expiries, usually vol is off its lows by then already, basically, right? So I tend to just sort of average in if I want to buy vol, because I think it's got cheap enough, and I think there's reason to own it post expiry, and I think that we're going to be pinned. I start accumulating probably a week ahead, and I average my long over the course of that week, basically.
Right. That makes sense. So you position ahead to capture the move before it starts, right? Because again, if you're buying puts down here, you're not happy with yourself. Obviously, shorter dated puts, that you'd be purchasing in here. So it is kind of a tricky game, right? If you're just a day trader, ES trader, buying spider shares, etc., you don't have to worry about paying that vol premium quite as much. So shorting in the hole can arguably not maybe be as painful, but here you lose on the delta, right? Because the market bounces higher, and then also vol kind of gets crushed. So, you need to be a little more careful with when you time those put entries.
Yeah, it all depends on your time horizon, right? If you're a day trader, then you can't really do what I'm doing, basically. But I don't trade it like a day trader. I think of it as I think between this OPEX and end of August, we could see some more volatility as the market frees up a bit, and there's quite a lot of bearish things on the horizon that the market may decide to get more nervous about and decide they want hedges for, and that will create a bid to volatility. Then I'm accumulating vol now to have that vol for a good week or two if my view plays out, basically. So I don't care about these day-to-day 20 tick moves in the S&P, because I'll just take those rallies as opportunities to buy a little bit more vol and average into my position, basically.
Yeah. And so, I might pronounce his name wrong, Syria. He asked a really interesting question, apologize. But, he said, when I say if 4420 breaks, do I mean, you short SPX as soon as it breaks under this level? There's really what happens that I think is it's a structural difference in the way that the market operates if we break this 4420 level, right? So I don't feel the need to try to gamble and then short the minute that it breaks this thing, right? If we close above this level, then I give bulls, the bullish sort of mean reversion, position the edge, right? But if we close below this, then I got to think, just as Imran said, about, longer dated hedges, right? Structurally changing the way that I trade. I tend to look for mean reversion on an intraday time frame as well as a multi-day time frame, when we're above this vol trigger level, right? So yesterday we Fed overextended, right? And so selling call spreads, obviously we're doing this for the benefit of hindsight. Selling call spreads are a really interesting trade, right? Or shorting the market back into the main, where the main gamma is concentrated, right, in the 44.50 area. And that's also why I thought that we would get more of a bounce here this morning. That didn't really manifest. We got sort of one early, but you could see that, or you could feel that there's a tone change here happening, right? So, I think just trying to say, okay, this line broke, so I need to start shorting with my whole account is not really what you're doing. But this should put you on alert if we close below this level. You want to be much more defensive, right? To buy the dip is not so easy as it is, here, right? Or the last several days.
Yeah.
What about single stocks? You got anything interesting that you're watching? I know you're not a huge single stock guy, but I want to
I
say,
haven't really. I've been more concerned with this. I've been playing index and a bit of crypto lately. I haven't really done too much on singles, to be honest. You tell me what have you seen?
yeah. Well, the thing that I find interesting is, it feels to me like it's been a retail pain trade. I mean, these guys had just unbelievable, caught some unbelievable moves, and now what I see happening in kind of the bigger meme stocks is the gamma position builds and the volatility. The relative volatility is just getting pulled out of it. And, there's so many conspiracy theories and the like built into a lot of these trades that are just not making money anymore, right? And so how long do you keep retail in the market or interested in the market if they're not getting that same fantastic return? You mentioned that you're big into sort of Bitcoin and watching those markets. And, I that market seems way overdone as well to me, right? And that may be the last sort of bastion of retail success at the moment.
Yeah, I mean that's probably sucking more retail back into it, given that the meme stocks have got killed and Bitcoin's recovered recently.
Yeah.
I mean, I'm hearing the NFT space is absolutely exploding.
I'm so lost on
so NFTs. I mean, I'm not an expert by any means, right? But NFTs are basically like artwork and collectibles, but in the crypto space, right? So it's a way of having a digital piece of intellectual property, let's call it a piece of digital art, and you stick it on a blockchain and you basically have ownership of it, right? And that is the authentic, scarce thing. You're trying to add scarcity to a digital thing, which in theory anyone can just copy and pass around to a million people. You're saying, no, this is the scarce version. This is the original, basically. Now, it seems a bit strange to me that people care that much about the original, that they're willing to pay like ridiculous numbers for it. But the point is that NFTs, a lot of that is built on the Ethereum blockchain,
right?
And it's driving demand into that space. So Ethereum and Bitcoin are the two large caps in crypto, and Ethereum's caught a massive bid recently. It's been outperforming Bitcoin, and partly it's because of this kind of blow up in volumes on the NFTs.
And I think that, the use case for NFTs and even crypto in general, you could see some of them start to form, right? And to me, it's sort of like the internet in 2000, where we all knew that the internet was the next wave, right? But the valuation of a lot of those first stage, internet companies was just ridiculous, right? I mean, that was the 2000s bubble. And I think there's so many parallels to that, right? Because there's also this sort of wave of, I see it often on Twitter, like, oh, you just don't understand it, right? That's why, you're not justifying these valuations or how expensive, some of these NFTs are or how things are trading, right? And I remember it was the same thing in 2006 and 7 where, I was sitting on the desk at a bank and, I was doing fine, but I had friends in the real estate market who, they weren't Albert Einstein, but they were realtors or underwriters or whatever they were doing, and they had fancy cars and they were living the life, and housing prices were crazy, and you go, this doesn't make any sense. And it was like, man, you just don't get it, Brent, right? And then, eventually those things correct, right? And they find value. It doesn't mean that NFTs have no value or there's no future in that market. It's just like...
I totally agree. I mean, it's one of those things like I'm riding the wave. I got in last summer. I'm riding the wave and I'm loving it. But
you're a trader.
I'm doing it with hedges. I'm doing it with optionality, such that if it goes to zero, and it probably doesn't go to zero, but if it has a major correction, I don't feel pressurized to liquidate. I'm in a safe spot. I'm covered. I still retain some of the gains that I've made since last summer, and I kind of manage my risk that way. And the good thing is there's a liquid options market in Bitcoin and Ethereum to be able to do that, basically, right? So it's quite nice to be able to ride a wave on this asset that arguably still has a lot more upside because the whole world is still adopting it slowly. But if it was to decide to go pop, you can cover your risk, basically.
Yeah. That's a good point. You are a trader, not an investor. I imagine you're going to be a lot more fast-footed there than I think a lot of people will be. So, and to that point, the Tether thing is so interesting. Do you have a view on Tether? I mean, those you don't know, it's a stable coin. It's calculated that it has, I believe it's the 5th largest holder of commercial paper in existence, along with Vanguard and JP Morgan and some of those others, but they won't tell you what the commercial paper is.
Apparently they hold some of their own commercial paper.
Or Binance's crypto, right? Or some of their own, right? Right. It's an IOU to themselves.
So yeah, there's loads of people who think Tether's a complete Ponzi.
For a long time too, right?
Yeah, and it's been around. That story's been around for like 4 years. So it may well be a Ponzi, but I kind of feel like the crypto space has outgrown it. Basically, it kind of doesn't matter anymore for some reason.
Doesn't matter anymore, huh?
Why that's the case, I'm not entirely sure.
No, that's great. I mean, it's a great view. I mean, the market clearly doesn't think there's any issue there, right?
Yeah, I mean, it's not new news. So I don't know what's suddenly going to change in that story that's going to make it an issue. What that hasn't already made it an issue. See what I mean?
And I was I was curious about that too, because the New York Attorney General came out, and fined them, right? And you would think that if she saw the just complete and utter fraud happening there, that there would have been a stiffer penalty and or something else would have immediately come out of that, right? Unless she just sort of referred it to somebody, with bigger guns or something. I don't know. But anyways.
And there are other stable coins like USDC, obviously, is another one. And there's all sorts of, there's lots of talk about central bank digital currencies, the likes of Facebook and their DM digital currency that they're launching. Apparently, basically, there's this big race going on to figure out the future of money, right? And it's kind of... Crypto was trying to have a crack at it in a decentralized form, but really, is it going to manage it, or is it going to be central bank digital currencies, or is it going to be some kind of one of the tech giants creates a form of money because they've got a ridiculously huge network of users that they can just start, transferring monetary value and create their own token and basically do it that way.
Right.
So there's a big debate about that at the moment. And China are the furthest ahead in terms of central bank digital currencies. The UK have been talking about it a lot. I guess they're somewhere in between. The US is a bit further behind, I think, because the thing is, US don't feel under as much pressure because they've got the world reserve currency in the dollar, basically.
Right.
So why would they want to change the status quo?
Yep, and they can make you pay your taxes in US dollars. So.
Yeah, but other countries are coming and doing it because it gives them a lot more flexibility. And it's not good for the citizens, right? Like central bank digital currencies, it might make life more convenient for you in how you do certain things, but it takes away your freedom in so many ways, right? And there's a risk that they can say, oh yeah, by the way, that money in your bank account expires in 3 years, so if you don't spend it, you won't have it for much longer.
That's right.
It turns your money into air miles, basically. It turns your money into like Avios points, like bank. That's what you have in my British Airways loyalty points, right? It turns your money into loyalty points, which if you don't use it by a certain date, you don't have it anymore. Right. And that's a horrible state of affairs for people, basically. Who don't have the freedom to do what they want with their money, basically.
It's a bit Orwellian. So.
Exactly.
All right, we are kind of turning toward the close here, so I think we should probably look for a few questions here, and then we'll probably end it there. So, gun to your head here, Imran, while I look for some questions. You think we're gonna hold this 44.25? You think the kind of lows in for the day, for the week, or are you?
Yeah, I mean, the fact that we held that 44.20, I mean, I thought today we were having a go at breaking it, given the price action that we ripped last night and then we failed again at 44.30. I thought today was the day to break. The fact that it's held 44.20 and we're kind of trickling our head back towards that 44.50 strike, we might manage to hold it until the end of the week, right? But it's starting to look precarious, right? Yeah. It's definitely starting to look like this market wants to roll over a bit. So, that would probably be... I would use rallies to start accumulating a bit of long vol, a bit of tail risk type stuff. Right. That's what I've started doing already. Like on that rally last night, I picked up a little bit of VIX futures. So, that's kind of my mode at the moment. I think playing into the end of the month and early September, I think that's probably where I'm leaning, basically. And someone here, Rollet, I don't know what his full name here, I apologize for that. He says, is it best to just reduce exposure and free up some cash if you think a move is coming down? He says that we sound very bearish here. And I would I would just say
buying puts is insurance, right? And I don't think you always need to carry that insurance. This is my personal, not trading advice, etc. But there are times when it makes more sense to carry more insurance or to carry insurance, and I think that's kind of what we use this vol trigger level for, right? That's why I use it for. The market is now positioned. So do I want to hedge some out? Do I want to adjust some of that long exposure that I have? This is a convenient way to signal that to maybe add some protection.
Yeah, I mean, what I would respond to that is that it's all about your time horizon, right? So if your time horizon is a longer term investment time horizon, then there's no reason to really be nervous, right? Because whatever type of drawdown we get, the Fed is going to react, more stimulus is going to come. They don't let markets go down for very long, basically, right?
Yeah.
Okay. And I don't think that dynamic suddenly changed. Okay. If your time horizon is weeks, then yes, there's potentially an opportunity here to play a downside move, right? Now, downside moves can be tricky to play because you blink and you miss it and then it rallies straight back. So some people just don't bother playing downside moves because they're so tricky to play. I mean, just being an options guy and being an index guy, I tend to get excited about playing downside moves, right? But generally, I'm not doing that in terms of, I'm not pivoting my entire portfolio negatively.
Right.
I've got a long-term structural portfolio that has asset allocation across a bunch of asset classes I've been in that for a long time. I'm not doing anything with that. What I am doing is putting on a few little tactical short bets over the next week because I fancy a little pullback. And if that pullback comes, I'll get to monetize that and that'll be a little bit of extra pocket money for me. And if it doesn't happen, it'll bleed a bit of cash, but I'm still in my long-term holdings,
right,
which are structural, which are going nowhere, basically, right? So that's kind of how I play it. I have my tactical short-term stuff, which tends to be more bearish when I get nervous. And I have my long-term structural strategic stuff that kind of has to be long risk and has to be long assets because of the world we live in and the way the system is. And then you just kind of pivot your allocation according to which assets you want to be in. So you might be a bit underweight bonds, bit more overweight commodities when you see inflationary dynamics going on. And if you're moving towards deflation, you might pivot back towards bonds and out of commodities. And then you're probably going to keep your equity exposure fairly kind of stable, to be honest.
Yeah, exactly right. So you can hold those. You don't have to worry about the tax implications. Just maybe buy a few puts when you think this level gets broken, right? And you can keep it sort of simple and don't need to do anything drastic if you're not as active or sort of adept at trading as you are. So that's interesting. What about China stocks here? I think we'll take that last question, then we'll probably end it there as we're getting towards the final hour of what could be an exciting close here. So do you have any view on some of these stocks? BABA, the HSI, QUEB, which is their internet index. I mean, is there some point where you start to take a look at these things? And
yeah, I mean, I already tried playing KWeb a while back and got my fingers burnt a little bit. As I think a lot of us have, to be honest.
Yeah.
It's one of those things. I think the problem with China is unless you've got some real edge in knowing what the hell those authorities are doing, is it really worth touching it, right? Because whilst it definitely feels oversold and it looks like it could easily bounce a long way, we don't know where the floor is in this stuff, basically, right? So,
yeah, you have no idea, right?
It's really hard to get a gauge on where the true floor is in this stuff when they can turn around and give the entire edtech sector and say your profits, they don't exist anymore, basically, right? So, so when they can do stuff like that and move the goalposts, it's kind of now not really a tradable asset anymore for me.
Yeah.
Right? Unless you get some real clarity on what they're doing going forward longer term, you can feel like, okay, this stuff on valuation doesn't make sense here because these companies will be allowed to make money and, they're not going to just keep clamping down like from one sector to the next. But I don't, other than just looking at the chart and saying, my God, this thing's oversold, I don't really have any strong reasons to be getting involved with it anymore.
Yeah, I think it's a very good point, and it's still pretty interesting, that this vol has not, bled into or affected the U.S. stocks, at all. Yeah. It's really, I mean, there could have just been really a rotation, right, or an initial rotation out of here. But
I think that is what's happened. I think that's partly explains why the Nasdaq's held up so well. Because there's been a load of money that maybe was diversified and partly in China tech and in US tech. And they've just said, well, we can't touch China tech. So what are we going to do? you might as well just put it back into mega cap US tech, right? So I think that may well have explained some of that strength in the Nasdaq, you know. But if that's now exhausted and there's no more rotation that needs to come out of those areas into US tech, and we've seen that this week, right? Normally, when bonds rally and yields come down, that's usually the beneficiary is usually tech stocks in the US. Tech stocks have gone nowhere this week, right? So that's maybe signaling to you that some of that rotation dynamic is exhausted. There's no more money to rotate into tech. So it's a case of now, if there's reasons to be concerned about the world and the market, everything can kind of sell off together because there's no reason to favor tech over other things. You've already done that rotation. Yeah.
I mean, this is a pretty unbelievable divergence here. This is the this is the K web, and then here's the Q. So it's it's quite a separation.
Yeah, it's amazing. I mean, look, for those, maybe they have got options in K web, right?
Yep.
For those who don't, want to take a speculative punt, short dated options obviously always give you a bit of leverage to a bounce. I don't imagine the vol's that cheap though on K web options, given how much the thing moves. Call spreads are better from a volatility perspective, right? You don't buy too much vol at expensive levels, but I wouldn't be buying any actual outright delta here without any protection because I don't know where the floor is.
Yeah, this is no bid. That's what that is.
Yeah, exactly.
So that's something else. So, all right. Well, listen, I'll let you guys know it's very late there. We're gonna get ready for the close of trading up here, and I want to thank you for taking the time to come and hang out and talk to me again.
Always a pleasure to talk to you, Brent.
And let everyone know how they can get a hold of you, of your site, your educational materials, and all of that. Sure.
So I'm options_insight on Twitter. My website is www.options-insight.com. You can find out all about me, all about what I offer and what I do on there. There's also a community that I run called Macro Insight, where I give weekly Zoom calls talking about everything macro, talking about the markets, how I'm trading them, any option trades that I'm putting on, things like that. There's a Telegram chat as well. So feel free to ping me, DM me. We can talk about it.
All right, and if it comes out that Trump wins the election, we're gonna have we'll do a special
overturning the previous election.
We'll do a special live Zoom as soon as we find out that information. All right, that's a deal.
that would be quite something, wouldn't it?
It would be. All right, buddy. Have a great night. Thank you everybody and enjoy the rest of your day.
Thanks, Brent.